I was at an event the other day and someone said, if you could change one thing in your business or the industry and you had a magic wand, what would it be? And it's this. I said duration discounting. I did an article about this and it feels like we're that meme where they're all pointing their guns at each other or their fingers at each other. And, the regulator looks at the advisors and said, you've got to provide the best interest to every single client. If we don't have that discount on our policy, then we're going to lose market share. So then we'll slowly discount. And then it's just kind of increased and escalated from there.
Sounds like you're not a fan.
Absolutely hate it.
It's that trade-off of going, how much is underwriting actually costing me as an individual in time and effort versus the premiums I'm going to save. If I can save 25% for the same thing, my premiums are $5,000. Saving $1,000, is that a couple of hours to do the underwriting worth it? If my health hasn't changed, probably. We've been pretty disciplined and stayed away from the C word.
What's the C word?
Churn.
Oh, churn. I had another C word in my head that I thought, I don't use that word.
Hi, I'm Trent and we're here for another episode of My Risk Advisor. Today we'll be speaking about durational discounting. I'm joined here with Phil. How you going, Phil?
I'm good, Trent. How are you?
Very well. So today we're going to speak about durational discounting. Can you tell us what it is exactly?
All right. So durational discounting is when an insurance company gives a discount in year one that just within a certain number of years tapers off. So, some insurers are discounting at 30+% in year one. Year two, it's 27%, then a little bit less. So common amount is around 25%, and it kind of tapers off over 5 years. So if you are a new policyholder to the same insurance company after 5 years and go through underwriting again, then you'll get that 25% discount again.
How did we get here? When did it start? What's going on?
So AIA were the first to bring it in, and they do acknowledge and apologise to the industry that they brought it in, but it's pricing competition, a way to manage. I mean, really, at the end of the day, a lot of inflows into an insurance company goes based on their year one premiums. Whether that's the rise of general advice, I actually don't think that's the cause of it. But, general advice, you're giving just a list of products and they self-select. There's no discussion, or there may or may not be a discussion around the pricing mechanisms and having durational discounts. But to be honest, most advisors don't understand that it's happening. And then, you're making a recommendation and you look at, who's the cheapest, got to save the client money. And so that's how it's happening. So the insurers feel like, well, if we don't have that discount on our policy, then we're going to lose market share. So then we'll slowly discount. And then it's just kind of increased and escalated from there. So
sounds like you're not a fan.
Hate it. Absolutely hate it.
Number one hated item at the moment on Earth?
It's the top 5 when it comes to the insurance. I actually think it's probably the most broken bit of our industry, unfortunately, when it comes to insurance and advice.
Yeah. Why is it a major issue for our clients? You've touched on a few things, but what other things you've got?
Yeah, so it's just like this this circle. I did an article about this 12 months ago, 18 months ago, and it feels like we're that Spider-Man meme where they're all pointing their guns at each other. Or their fingers at each other. And so, the regulator looks at the advisors and said, you've got to provide the best interest to every single client. And so as a part of that best interest, premiums are a significant part of that. Now, the regulator said that premiums aren't the only thing to meet best interest, but it is a clear, easy way to demonstrate that the client's in a better position. So us advisors feel like we are kind of pushed towards year one premiums. And therefore we'll recommend based on that. The insurance company says, well, we're going to be out of business if we don't, discount. So then they do it. APRA then also says, well, it's unsustainable pricing. You got to fix it to the insurers, and the insurers just keep pointing their fingers back at the advisors. So there's a whole bunch of the advisor pointing their finger at the regulator saying, well, you're forcing us to do this. The regulator pointing at everyone saying, well, you guys need to pull your heads in. So, I think that's why it's destructive, because the advisors have to recommend based on the individual best interest, even if we don't think it's in the pool's best interest.
Yeah, we've been pretty disciplined and stayed away from the C word.
What's the C word?
Churn.
Oh, churn. I had another C word in my head that I thought, I don't use that word. So, for sure. It forces advisors, we've talked about it in our business, like, we are going to have to churn our clients' policies, because if there is a risk that if our client can get a better price with the exact same insurer if they go through underwriting, should we do that every 5 years if we can access that 25% discount?
It's that trade-off of going, how much is underwriting actually costing me as an individual in time and effort versus the premiums I'm going to save. If I can save 25% for the same thing, my premiums are $5,000, I'm saving $1,000. Is that couple of hours to do the underwriting worth it? If my health hasn't changed, probably.
And the other thing that's difficult about it is this discounting is so opaque. It's so hard to understand. Like some insurers are pretty good. They put it on the quote. They talk about a 25% discount in year one. Now, they don't talk about how it comes off necessarily. Some insurers don't have it on their quote at all, but they have it in their advisor guides, so we can find out. And some insurers just don't disclose it at all. They talk about it as it is it's just their pricing mechanism. And from the insurer's point of view, the justification, the way they talk about it is that if you're 5 years or 10 years away from being underwritten, you're higher risk and more likely to claim because there's health events that happen in that time frame. So we need to then price it higher for someone who has done underwriting 10 years ago versus someone who's done underwriting today. So it is I understand their point of view, but really some of the shenanigans is clearly just trying to get market share.
Yeah, there's a clear distinction about why they think it's right, but it's being used in a completely different way with advisors, clients, and clients aren't seeing it as the way they want it to be seen in terms of the insurers. So they're just going, well, today's price is different than what I can get. Why don't I go somewhere else?
And it's a loyalty tax. Yeah. So I'm loyal to this insurance company and I'm getting taxed for it, which is, imagine as a homeowner and you've got a mortgage. Imagine my mortgage rate just went up by 1% every 5 years, and then it forces me to move. That would be so frustrating that I have to move. And my income has to be able to support that loan still, because same thing with mortgages. Effectively, a lender doesn't know your servicing capabilities for the next 5 years after you took out the loan. So they could theoretically do the same thing, and they, to be honest, they kind of do a little bit, but nowhere near the pricing discrepancy between a new policy with the insurer and the non-discounted policy.
Yeah, it's bringing it more towards the general insurance, where if you're not shopping your car insurance every couple of years or your home and contents insurance every couple of years, you're probably losing out. But with those two things, you're not really doing the underwriting part of it, except for cars a couple of years older, so the pricing is different, but you're not looking at your car's oil changes and that sort of stuff. It's health, where your personal insurance, you've got to be looking at your in-depth health.
Yeah, exactly. I mean, for car insurance, if you move house, then sure, you maybe get a higher premium or a lower premium based on the location, but it's completely different kind of mechanism. And I agree, insurers are pushing us towards this churn. We've got to churn every policy every so often.
Yeah, so if we're rewriting policies every 2, 3, maybe 5 years, how's that going to affect their total insurance market, their profitability?
Yeah, and this is the frustrating thing about the whole thing is, insurance companies, they talk about, we need the policy to be enforced for 7 years before we break even on it. And the current model and the current way of pricing means that if we're not rewriting every 5 years, we're potentially at risk for an AFCA claim. If a client can get the same premium at a cheaper, same insurer, cheaper premium for the same cover, why wouldn't they? And so, it is unsustainable. I think the regulator needs to step in and kind of tell people to pull their heads in, because we did some analysis. There are some companies that I think do it on a reasonable basis, that their fundamental reason for doing it is underwriting. And Tao is a great example. They do a really good job at going, what is the actual risk on our pool based on being X amount of years away from underwriting? But there are some companies that are straight away just feels like they just put their finger in the air and just went, how do we get short-term, inflows? And we won't destroy our business because those premiums will go up significantly. So they're the ones that I think the regulator can come in and go, show us how 25% in year one and 5% dropping every year makes any reasonable sense and is aligned to any kind of like underwriting or claims experience. Because I think as soon as the regulator asks those questions, the insurers who are doing these hefty discounts will be like, yeah, sorry, our bad. Look, to be honest, they may just come to the same numbers and just rejig, maybe change the percentages slightly, but
Couple of crafty accounting pieces.
yeah, there's a lot of smart people in the product providers.
Yes, the next issue we consider is going, well, in year 2, year 3, we're now sending this policy elsewhere. What's happening if we're unable to send the policy elsewhere, and what happens to that insurance pool overall?
Yeah. I mean, same thing with the insurers want a policy to be enforced for 7 years to be profitable on that policy. But if we're moving healthy lives, the unhealthy people are going to stay. And so it then means, okay, instead of 7 years of the policy being held, it actually needs to be 9 years or 10 years before it becomes profitable because they're more likely to claim. And so I think there is a really interesting dynamic in the market at the moment that goes, how do we get ourselves out of this? Because, you're only going to keep the unhealthy lives. And as long as you've got your doors open to bring in new healthy lives, from that are being rewritten from insurance company A to insurance company B, then theoretically that's okay. But, if we're just going around the merry-go-round, picking the new insurer every few years, it's not very sustainable.
Yeah, someone's going to get caught holding the bag with a really unhealthy book, and it's just going to get worse and worse.
Yeah.
So we've been talking mainly around the stepped or the age-based step premiums, or age-based variable, if you will, premiums.
Stepped and level is. I feel like a boomer when I talk about stepped and level because the new terms I'm just like, it's too hard.
So let's just go stick with that. Stepped and level. Yeah. We're talking about step premiums here. This is where the durational discounting is because there's only one insurer that I'm aware of that does it on the level premiums. That may have changed.
I think there's maybe 2 or 3 now. That do it.
But talk to me about the distinction between step and level and how that's potentially changing recommendations across the board and what people are doing.
Yeah, so I mean, I think people have moved away from level premiums broadly as an industry. Insurers don't really like it because, as much as advisors, we whinge about insurers repricing. The insurers hate the fact that they have to reprice their level policies. They really don't like it. And so it's interesting that a lot of advisors who aren't aware of durational discounting will look at the difference between level and stepped in year 1 and go, oh, that's so unsustainable. Like that's such a huge discrepancy, and then the break-even cost is so big. But they're often comparing a non-discounted level policy with a discounted step policy. So not only is that premium difference quite big anyway, naturally, you're also getting a 30% discount off that step pricing. So it really skews in the favour of step. So, we did like level premiums in the past, and we believed in it for a whole bunch of reasons, and we may do an episode about why we liked it and what the pros and cons. But for all new clients, we just do step premiums and make the commitment to our clients that, hey, this is a policy that may be held short term if you're healthy enough to move it. And then it's a question of if it's a 25% discount over 5 years, do you rewrite it, at year 3 when you can gain a 15% discount, or year 5 when it is a full 25% discount to go back? They're the questions we're having, internally and with our clients. Like, how do we manage this?
Yep. On top of that as well, it's going through applications for increases on current policies and things like that. Just way harder than it should be for most insurers. So going back to rewriting it and starting a new policy for most insurers is actually far easier for us.
Yeah, which is disappointing because, bright-eyed, bushy-tail, going insurance only, thinking we really want to make a commitment between our clients, the insurance company and Sky, that we're going to place the cover where it is and then move it up or down as the client's needs change. Because there are some great features, guaranteed future increase, where we can just a life event happens, you buy a house, you can increase your cover by $250K. Some of those things are really great. You don't need to go through underwriting. But we are, looking at how do we pivot our business to, churn our policies. The regulator may not like hearing us say it. It's kind of a bit on the nose, but it is churn for the client's best interest. And that's where it is disappointing, and this is why it's my biggest frustration. And I was at an event the other day, and someone said, if you could change one thing in your business or the industry, and you had a magic wand, what would it be? And it's this. I said duration discounting. If we could get rid of it as an industry, we would all be better off for it.
Yeah, it's really what is best for this individual client actually isn't best for the overall pool at the end of the day. So if we treat every client as an individual and we want to do the best by them, which we're obligated to, we need to be moving it. But overall, it's really just hurting the overall market. And in the end, that individual client.
Yeah, exactly. So it is interesting. We'll see where underwriting goes. Like, will underwriting become tighter in the future? Because, well, they can be tighter potentially because they may hold the policy and they're underwriting a new policy. So will they be more flexible on underwriting, or will they be a bit tighter on it? Because, well, we may as well just keep it. They're probably not going to move if we're giving exclusions, or even if they do move and take on the exclusion when they otherwise haven't, well, great. As an insurer, we're reducing the risk. And so there's some of the shenanigans that'll be really interesting to see. And again, it's a frustrating thing. We talk about the market for insurance advice is decreasing massively. It's because of all these shenanigans that are going on that is causing this kind of frustration from advisors to be like, I don't trust insurers. And then you talk to the insurers and they're like, we don't trust advisors.
Yeah.
And it's fair enough. We don't.
And we're back in the Spider-Man meme.
Yeah, exactly. Yeah, we're back there.
Very good. So we know there's not going to be one insurer that's able to jump the gun and just go, we're not doing durational discounting, because they're potentially going to be 25% out of the market for their premiums. How do you think this is going to be solved? Who do you want to solve it?
I think, there's a few players in the market. The regulator could step in, because the regulators have come out and warned insurers a few times about unsustainable pricing, what I call pricing shenanigans. But it's a letter that APRA and ASIC jointly wrote. And so I know words are important, but how much is a letter actually influencing change? Well, it's clearly not. Millions of dollars of inflows to insurance companies will influence it. So I think the regulator could step in and say, hey, how do we actually prove this discount actually makes sense from an underwriting point of view? And then, just get a lot of data, which APRA collects heaps of data, but then start putting pressure and go, all right, prove it. So there's that. I think licensees can all come together. The big licensees have a huge influence on insurance companies. Like, coming together, and I know, we can't collude. We are businesses, we can't collude, but we can discuss, do we put caps on discounts? Like, if every licensee said, no, if you're an insurer who discounts above 20%, you're going to be off our APL. Yeah. Now, we'd all have like two insurers, so maybe it needs to be like 27%, and then it kind of that cap then starts to be created, and then you can slowly bring that down. I think it is not unreasonable to give like a 10% discount for a newly underwritten policy. It's still a little bit of a bad taste in a client's mouth to having that loyalty tax, but it makes sense. But 30% or 37% or something ridiculous is way too much.
Yeah, bring it back in line and making it a mandatory way of going, well, this is the maximum you can do. Everyone's just going to go to the maximum, realistically.
Yeah,
You're going to stay there, and then you're doing the pricing on the actual policies to win the business, and obviously you're underwriting everything else that follows.
Yeah, but it is one of these interesting things, because like I did an article on LinkedIn. I would probably have a guess if you surveyed 100 advisors, and maybe not the top 25% who are writing 25%, like, whatever, 183 are writing 25% of the business. Maybe even the bottom 75% of the advisors in the industry, and you ask them to give an idea of what this duration discounting was, I reckon you would probably get people thinking it's capped out at 10%, if at all. Yeah. And so
if they knew about it in the first place.
Yeah, and that's where it's a matter of, I think, shining some light on this does matter. When I did my article, and I'm not going to say an insurance company changed their pricing for me, because they definitely didn't. But like a week or two later, Ascender came out with a new pricing structure, and they actually reduced their discount, which is great. And they reached out to me and said, hey, can you update our numbers? Because we've actually come down from, I think it was 30% to 22%. And I was like, for sure. If you're bringing it down,
I'll celebrate it.
Yeah, I'll celebrate it. And then also after the article, one insurer introduced it. The one insurer who didn't have it introduced it at the highest rate, the second highest rate on the market. And so again, they should be called out on. So it's a difficult problem to solve, but I think it is super important for licensees to come together, or advisors and advisor groups. FAAA couldn't care less. Like, to be perfectly honest, they really don't care about insurance. It's a sinking ship. They're happy to let it sink. But the advisor collectives who are doing risk can probably come together and try and And I know some licensees like Bombora are super vocal with the insurers about it, and they're doing a great job. MBS are kind of doing some stuff as well. So some big licensees are talking about it. What do you think should be done about it, Trent?
I think it should be capped as well at some point, and I like the idea of capping it at, say, at 25% at that higher rate, and then similar to your super guarantee contributions, they were nothing in the 1990s or whenever it was before I was born. And then they started bringing in the mandatory at 3.5% or 5%. And then in the last 5 or 6 years, they've gone from 9 to 12% now. So just having a scale of going, insurers, here's your forecast over the next 10 years, you need to get down to 10%, and here's what your caps are going to be over that journey. And it might be 10%, it might be 15%, but I think they need to collude a little bit, or the regulator needs to come in and go, this is what we think is reasonable. Because yes, it is reasonable to have some form of it, but not at 30%. Yeah. So just having that cap to force it upon them. Yeah,
I think that's a good call out. Just APRA come out and say, over the next 20 years, this is what it will be. And then the APRA can change over time in terms of not make it more aggressive or less, but go, all right, the market's really going to fall over, so we need to do something about it. All right, let's make that transition slower or quicker or. But yeah, I think having some leadership from the regulators to go, this is unsustainable, instead of like multiple letters that we're producing and sending out, actually put some regulation in place would be super helpful.
Thanks for joining me, Phil. It was a great discussion here on our durational discounting. And if this interests you, it'd be great to see you on the My Risk Advisor Facebook group. We'd love to have a discussion, whether it's the first time you've heard about this durational discounting or you've heard about it previously. Love to hear your thoughts, how we should solve it, and anything else that you want to discuss. Thanks for watching, and see you next time.